Hello, welcome to the Mutual Fund Show. I'm Niraj Shah. Over the next 25 minutes, we'll talk about the middle path with a shark. Now, if that confused you, let me try and simplify it for you. Our guest today is Radhika Gupta of Edelweiss AMC. Can I call you Radhika Gupta of Edelweiss AMC?
Yeah, you should call me Radhika Gupta of Edelweiss AMC.
So, why do you think I introduced you the way I did?
I don't know, because I'm making an appearance on a show called Shark Tank, you suddenly think I'm Sharky. You guys have known me for so many years and I'm the last person to be Sharky.
No, but wouldn't investors in AMC schemes be happy that, as the saying goes, bulls make money, bears make money, pigs get slaughtered. I mean, I would want my money to be with a shark as opposed to a very neither here nor there kind of a mammal. So it's great to be with a shark.
Yeah, firstly, it's my personal money, but I say that each time.
No, but as
an investor, yes, I think as an investor, you want your fund manager to be prudent and sensible and buy at the right price, which I think is Sharky. But sometimes you have this perception that Sharky is also unfair to the other side, pushing someone to do something in a rush, mean, and that's not a very nice. I think finally investing is about partnering with managements, whether in the context of funds or in the context of personal investing. So nothing should be a lose deal because, investing should be a bit of a win-win deal. Yes, you want your asset management professional to buy at the right price, to be thoughtful, all of that. So if that's Sharky, then all Sharky for you.
No, I also want the investment professional. I want to understand the thoughts of the house which is managing my money, and want to understand what's the house view and try and see if my view aligns with that. So I'm trying to ask Radhika Gupta today, virtually at the start of the new calendar, about what does Radhika think is in store for 2024 after what's arguably been a banner year for the broader end of the spectrum and a miserable year for the fixed income market, so to say.
So I think 2024 is a year of transitions. That's what we call it. You're transitioning into a new interest rate regime. You had zero interest rates, then you had hiked interest rates, and now that regime is coming to an end. You have elections in two major economies, one of which is India. So I think you have a couple of these transitions that are happening. I agree, 2023 was a phenomenal year for the equity markets. But if you look at the forecast that happened in 2022, at the end of 2022, most people said we won't make money in 23. We were worried about, a hard landing in the US. We were worried about so many things. And I think for me, 2023 is a year that tells you that momentum turns in markets and no one can really predict how sharply momentum can turn. But 2024 really should be a year of more muted expectations. My biggest worry going into this year is the kind of expectations that people have when I talk to especially ordinary investors. I mean, they're whacked. Someone came and told me, invest in a micro cap fund, roz आधा % मिलेगा, and then I get nervous.
Okay. So you are not saying that. Let's divide this up into two. We'll talk about fixed income and other asset classes on the other side of the break. In this side of the break, let's talk about equity because that's what we're starting off with. You are saying that it's not that you expect equity markets to do badly and thereby equity funds to do badly.
Not at all.
Just saying don't expect the sky. What you'll probably end up getting is the clouds, and you should be happy with that.
Yeah, because if you look at the context of last year, see, India has had a period where earnings in the last decade were a little bit like Rakhi and Karan Arjun. You kept saying, ek din aayenge, and they never showed up. And then, in the last few years, especially post-COVID, what you're seeing is an earnings rebound, and you're seeing double-digit earnings growth, and all of that was happening. Now, in early 2023, when people were asking me the same question about equities, including about small caps and mid caps, which were the story of last year, I said, don't panic. We may look okay from a valuations point of view, but we're very early in the earnings cycle. And I think that's what you started to see. Companies are delivering the numbers and companies are delivering the numbers across the board. Now that okay in the valuation cycle has stretched to a little pricier on the valuation cycle. Fundamentally, companies are doing well. The economy is expanding across manufacturing, across financial services, across most segments of the economy. You are seeing earnings contribution, but it's important to moderate expectations because remember last year you had mid-cap and small-cap funds deliver 20 to 40%. And that isn't an outcome you're going to have every year. So every year, not being saying moderate expectations doesn't mean equity markets are going to do badly. It literally means the middle path.
Could it also be a year, wherein typically when the index has such a flourishing move, not every fund is able to outperform the benchmark, and we've seen instances of that in the last calendar too. Could it happen that the index by itself is a lot more sedate, as you said, but because individual pockets could have gains, and therefore it might actually be for an opportunity for fund managers to be able to outperform the index, especially in flexi cap / multi cap / mid cap / small cap categories?
I think it is more of a stock picking year, these periods happen. I remember when I joined the industry in 17, Niraj, everyone was writing off large cap funds saying there's no alpha left. I remember this story. Now, if you look at last year, large cap funds have done super well versus the index. Most large cap funds have meaningfully beaten the index or done something. Mid cap funds, by the way, have trailed indices in some part because of the kind of names that have contributed to the mid cap rally, or small cap funds, for instance. So these things are more hard to figure out. If you have a more muted year or a more normal year for mid and small cap growth, by the way, you will see alpha starting to come back. And that's true of large cap as well. These things are very difficult to predict.
Most certainly, but what might be easy to predict, I'm just trying to understand if you believe in the same way as well, because most of your peers who've come to me, on whether the CIO side or the CEO side, are all of the opinion that it's the year of the large caps versus the mid caps and the small caps, and sometimes what worries me is consensus.
So my view is a little different from the consensus trade, and I'll tell you why. I think we need to look at the fact that the structure of India's market has changed. We grew up, so if you went back 25 years in India's history, the average size of a large cap company was about 3,000 crores. Today, today a small cap company has an average size of 12,000-13,000 crores. A mid cap is 38,000 crores. Large caps are in lakhs of crores. हमारे बच्चे बड़े हो गए हैं in some sense. So the perception of what mid and small cap were 20 years ago or even 10 years ago has meaningfully changed. In fact, the way mid caps interact with the market in terms of earnings calls, governance, all of that has changed. I also think that if you need participation in India's economy over the next 10 years, a pure play large cap approach doesn't work because large cap is tech, energy and financial services. These are very concentrated indices. If you want a China plus one theme, if you want a chemicals theme, if you want a capital goods theme, if you want a capital markets theme, I'm hopefully in a good industry, then these plays are in mid and small cap. So I think the approach to the year, and one of the mistakes that we make in the context of mutual funds is try to do this, what's the approach for the year? With where we are in India, we should really think decadal, not individual year.
Yes.
And I think the decadal story is a multi-cap story. I'm not even saying flexi-cap, by the way. There's a nuance there because flexi-cap tends to be about 70% large cap.
By definition?
Not by definition, but by benchmark, and therefore by outcome. So there is a difference. People think flexi and multi is the same, but flexi, if you look at the benchmark, it's NSE 500. And so most funds end up being close to there. Multi is more, like when we think of a multi-cap fund, it's 40, 30, 30, something like that. 40 large, 30 mid, 30 small. I think that's a much more accurate reflection of where India will be over the next 10 years. And I get very worried. The reason I'm away from this consensus trade is I get very worried with this today large cap, tomorrow small cap, this. For an ordinary investor, you get the timing terribly wrong and you end up paying a lot of taxes and fees in the churn, which is not something most of us like to do. I'm a big fan of bundled solutions. And that's why I think multi-cap, the middle path.
Multi-cap. So, okay, some would argue that an exposure to a multi-cap fund, which has had a great year by the way, but an exposure to multi-cap fund would mean that my fund manager or the fund house is a lot more constructive on returns from the broader end of the spectrum than others. And yet we are of course talking about how maybe just for 2024, I know equities are a long-term game, but for 2024, large caps might do better. So where is the dichotomy here?
So firstly, multi-cap funds have a little bit of flexibility built in. It could be 50, 20, 25, 25, large, mid, small. It could be 40, 30, 30. So there is a little bit of that leeway. Now, I don't know if large caps are going to outperform mid caps and small caps in 2024. What I'm saying is I don't want to make a decision for an investor based on 2024 because I firmly believe equity investing can never be about a year or even 3 years. And in today, when India is sitting, it has to be decadal. It has to be at least 5 years.
You'll still be judged by what your fund performs, sadly.
Yes, I will.
In 2024, relative to others, relative to benchmark.
I will.
तो आप क्या करोगे?
नहीं, and look, we all offer a wide basket of funds. I offer a mid-cap fund, I offer a small-cap fund, and I offer a pure-play large-cap fund. So finally, investors will make decisions based on what their advisor tells them, based on their own market view, and based on their own sense of asset allocation. But as someone who runs an asset management company, if you would ask me where I put my fresh money, that's the answer I can give you.
A multi-cap fund.
A multi-cap fund.
Okay, which also means that you don't believe that it'll be a year wherein, yes, middle path, average returns, but it's also a year wherein mid caps and small caps need not necessarily have a poor year.
Not necessarily, because earnings growth is finally supporting. And I really think you can't have a bulk of capital in a category which is 40% one sector, which is financial services.
In which case, Radhika, and hand on heart, I'm just trying to understand before we take that break. A large cap fund, you know, and the SPIVA scorecard is out there for everybody to see. I mean, listen, we can debate all we want, but the fact remains that a large portion of the industry is not able to outperform the benchmark, right? If flexi cap is 70%, let's say large caps in which ways, and if I want a large cap bias, would a flexi cap fund be a better option? And then joined to that is that if I, as an investor, believe as well, because I also have my beliefs, I like to have my opinions while I trust my money with a mutual fund, that if I believe that no, that's not necessarily the case, I'll go with a multi-cap fund. Why bother with a large cap fund, which has anyways not been able to even beat the benchmark? If I really want that large cap performance, I'll put it in an exchange traded fund.
I have two answers. If you want a large cap fund, if you want to be a tad aggressive, as I said, my multi-cap option is the right one. If you don't want to be, I don't think the alternative is flexi cap fund. This is going to sound very counter, but let me explain. I think the alternative is a balanced advantage or aggressive hybrid fund. If you look at an aggressive hybrid fund, that's 75% equity, 25% debt. The long-term performance of that is going to be the same as large cap funds with 75% equity exposure. So personally, I do my large cap allocation despite having a large cap fund with either balanced advantage or hybrid funds, because I get the same outcome, but at least with lower risk. And that's worth it.
And that's overlooked so much. People don't understand risk-adjusted returns per se. But this is fabulous. Thank you for so many great insights in this first half of the conversation. Stay tuned. Stay on, Radhika. Viewers, stay tuned. We'll slip into a quick break. We've discussed equities ad nauseum, and I think I got some really cool answers in this segment from an equity investors or seeker of what to do with equities perspective. We'll come back and try and talk beyond equity funds as well. Stay tuned. Back on the Mutual Fund Show with the CEO of Edelweiss Asset Management, Radhika Gupta. I chose my words carefully.
There you go.
No, okay. Radhika, so great first segment. Thanks for the equity view. Now, let's talk about beyond that. Now, we've done some macro conversations on the channel thus far. There's been this overarching view that rates, predominantly in the US, but even in India, will come off. And by virtue of just that alone, it makes bonds a reasonably attractive place even now, because not everything is discounted. I would love to understand, how does one approach fixed income investing via mutual funds in the current calendar, not just for 12 months, maybe for 18, maybe for 24 months, whatever it is?
So I run the largest book of long-term bond products in mutual funds in India by virtue of target maturity funds and Bharat Bond. And it's reasonable to believe that yields will come down and you will make money by holding long duration fixed income, and there are lots of those products. I also, despite being the largest holder, so I like the target maturity structure. I've always liked it because the timing is taken care. I do believe that people do a slightly poor job of timing when to enter long duration mutual funds, not the target maturity kinds, but the gilt funds, etc. They enter them at the wrong time, they don't exit them, and they have a patchy experience. So if you are a sophisticated fixed income investor and by all means know how to do this, go ahead and do that. Now you have to remember there was a very significant event in the debt fund world in 2023, which was called tax change in March. Now we can debate whether it's good or bad, but it is done. I think if you have to play fixed income today, if you're making 7-8% return, you're giving away 1/3 in tax. The better way to do this is through a hybrid fund, and I think we are seeing that already. Now, whether it is BAFs, equity savings funds, aggressive hybrid funds, multi-asset funds, all these constructs are a far more tax efficient way to address the debt fund allocation problem. So again, if you come back to my favorite 75-25 category, let's say, Niraj, you really believed in debt, and I do believe people's portfolios should have a meaningful amount of debt, it might be just more tax efficient to do it in 75-25 as a one pot khichdi meal rather than eat dal and rice separately. So I think that's the story for debt fund investors. Don't ignore debt in 2024. Very high temptation to do so because equities had such a great year. These days, if I go talk about debt, people are like, what debt? Why hybrid funds? Don't ignore debt. If you're sophisticated and know how to play the rate timing game, by all means do it. Otherwise, hybrid funds are a great tax efficient answer for most of us.
So in effect, for an average retail investor who may not know the exact time to enter and exit, most people don't, but let's assume that an average retail investor definitely doesn't, then just avoid that route. Choose.
And just do a hybrid fund.
Do a hybrid
and
fund.
just decide, I want to do 75 equity, 25 debt. Do it in a fund that has 75 equity, 25 debt. I mean, we all work very hard, and if there's a more tax efficient solution, it's good for everybody. And I think people don't realize the range of hybrid products that are available today. Like there's a construct called equity savings that's only 35 equity, 65 fixed income, and arbitrage. That's a great product if you want to be conservative. There's balanced advantages, is 65-35. There's a 75-25. So you pick your answer, but do it in a one pot meal.
Got it. And these bifurcations, if I can use that term, you would say are constant across fund houses, if you
broadly.
will?
I think these three categories: equity savings, which is broadly 20-30% equity, the rest safe instruments; balanced advantage, which is on average 50-60 equity, it's variable, balanced debt; and aggressive hybrid, which is 75 equity, 25 debt. This is very constant across fund houses.
And the tax advantages or the tax treatment would be similar.
Equity taxation products. All of these are equity taxation. And I picked these three categories in particular because they are consistent across fund houses and they don't have disputed taxation. They all have equity taxation. If you're looking to allocate short-term debt capital, like 3-month capital, the most tax efficient category today is called the arbitrage fund.
Precisely. I was going to ask you that as well. But just before I come to arbitrage, the advantage that an investor would have when she or he chooses these funds is that she doesn't have to think about whether the maturity of my money is tying with the maturity of the portfolio of the fund or no, and all that research doesn't need to be done.
And all that research, because most people in India understand equities. Unfortunately, our understanding of fixed income is extremely patchy, and I'm just being a little bit of a realist here.
Yeah. Agreed. So and this is very helpful. Now arbitrage funds, and I think there are a couple of advisors who I talked to have said that if you want, for example, that you have to make a tax payment in September, or you have to make something else, or you want to buy something, instead of choosing other products, choose arbitrage funds as the short-term answer to saving. You concur there? You believe that's the answer?
As long as you have money that's greater than a month. So this is not a liquid fund. This is not like I have to make a payment in 3 days. I'm going to do in and out, because that is expensive. But if you have money in the 1 month plus 2, especially 3-year kind of bracket, this is super efficient, because remember, your taxation is equity taxation. Under 1 year, it's 15%. Over 1 year, it is 10%. So that's very efficient. What an arbitrage fund does is it puts 35% of its capital into fixed income kind of instruments. The other 65% is equity for the sake of taxation, but it's perfectly hedged equity. So I buy X stock, I sell X stock in the same quantity. very good construct. I've been parking personal contingency money in arbitrage funds for 6-7 years now.
Got it. And the results have been fabulous.
The results have been great. Again, don't get agitated with 1 month higher return. Try to have a longer term view on everything in life also.
In life also, okay. Radhika, what has okay, just one question on multi-asset funds and then I get to this. I don't know whether you have it under the Edelweiss fund, but what kind of investors would a multi-asset fund be best suited for? The completely risk-averse ones or the ones which want bifurcation?
Okay, so I have a multi-asset fund.
You do.
Mine is the most conservative multi-asset fund in the industry because it's income-oriented. The problem with multi-asset funds is, the reason I can't give you this answer is, the industry has 40 fund houses and 20 versions of multi-asset funds.
Okay.
So I can't give you, and many of them have different taxation treatments. So some of them are equity taxation, some of them are the erstwhile debt taxation. So you really have to check what it is about your multi-asset fund.
What about yours?
So ours is an income-oriented product. So it's a conservative product. So it's equity, fully hedged, it's gold hedged, and it's fixed income hedged. So our alternative is to get a better solution to arbitrage. But not all industry products are like that.
Got it. Okay.
So that with multi-asset, you actually have to do fund-wise research.
Okay, and if you can't do that, please get an advisor.
Yes, please get an advisor.
Okay, Radhika, last couple of minutes left on the show. What has surprised you the most from a mutual fund investing perspective, because this is a mutual fund show, about 2023, and what is it that you're watching out for the most as a mutual fund investor in 2024?
So I think the SIP book of the industry continues to surprise me in a positive way, and the stability of it. I remember when I joined the industry, Niraj, in 2017, the SIP book was 4,000 crores. And everyone would always say, oh, there'll be a correction, this will moderate. And it structurally seems to be going up. And I think, you mentioned Shark Tank. SIPs have become a little bit of a meme. I think I did this poll on a Shark Tank set. How many of you know what a mutual fund is? Just with some crew members and all. Probably 50-60% people raise their hand. How many of you know what an SIP is? 90% of people raise their hand. So I think the popularity of SIPs continues to surprise me very, very positively. And I think that's a structural trend. In fact, I have this bold belief that India will have a 35,000 crore SIP book in 5 years. And for those who think it's bold, 5 years ago we were at 4,000 crores. So
doubling in 5 years.
Just imagine what that's going to do to our capital markets. What was the second question?
The second question is, what are you watching out for the most when it comes to 2024 as a mutual fund investor?
So what I'm watching out for the most is actually behavior of people, because obviously a lot of capital has gone into chasing things, as it always does, which are volatile, and where past performance has been exceptional. Not just mid-cap. Mid-cap I don't even worry about so much, because it's the next 150 companies. I mean, they're not even mid-cap in my opinion. Small cap, micro cap, these themes, these kind of things tend to worry me, because I think we're at a phase in India where a lot of new money is coming into markets, and it has to have a good experience. So I just worry about products where expectations are very short term and expectations are very lofty, and that's what I'd be watching out for.
Okay, well, Radhika Gupta, give us a sneak peek, 30 seconds. What should one expect from a judge who is investing money in startups?
Some of the straightforwardness of an investment professional who likes sustainable businesses with sensible business models, who's selective about investments. You can't take the investment professional out of the individual. But also hopefully the empathy of someone who appreciates stories and who's been an entrepreneur herself.
Exactly. I was going to say that. Somebody who's had startup in her blood.
Run one startup, and build Edelweiss Mutual Fund is also a startup. Exactly. It's a very small company. So.
As the youngest CEO of an AMC. Kudos. Great. Radhika, at some point of time in the year, we'll try and do a show around how to have more women investors into mutual funds.
We should.
We should do that for sure. So that's an appointment that I'm booking with you sometime in the next 1 to 3 months.
We should.
But thank you for joining us at the start of this calendar, at the start of our channel as well. Lovely having you.
Wish your channel good luck, and wish all of you a very happy new year.
To you as well. Thank you for joining in today. And viewers, thanks for tuning in to yet another episode of the Mutual Fund Show.